Today we are talking about business ownership and how to choose which structure to use for your new entrepreneurial venture. So, different forms of business ownership. There are a number of different forms of business ownership. The main ones that we hear about are sole proprietorship, partnership, corporations, and cooperatives. In this lesson, we are only going to be covering the first three because generally these are the three, between these three, that are chosen for most new entrepreneurial ventures. A cooperative is a wonderful business structure. It is a very unique structure, and it is generally used for businesses that are being created to meet a certain need in a community or for a certain purpose, not to make the owners money. Cooperatives generally are there to create opportunities, maybe for those people involved to save money. Like, for example, cooperative banks, those have lower fees because there isn't an owner that's trying to make money off of running the bank. But generally, if you are an entrepreneur that is wanting to start your own business for the purpose of making money and having that as your income, you're going to be looking between a sole proprietorship, a partnership, and a corporation. Also to mention, there are other ways to start your own business. You can buy into a franchise like a Tim Hortons or a McDonald's, or you could buy an existing business. But again, this lesson is primarily focused on if you were to be starting a brand new business. So let's get going. Our first structure that we're going to look at is what's called a sole proprietorship. Okay, the keys to this one, it is a business that is owned by one person. And in this situation, the law does not distinguish between the business and the owner. So in the top corner, if we think of the box as the business, we see that that owner is in the box or a part of the box. In the eyes of the law, the business is the person. And so if I started a sole proprietorship today, if I was to, go to the bank and get a loan, that loan would be in my own personal name. Okay, if I make contracts with people, those contracts are including my signature as me as a person. Okay, the business is no different than the person in the eyes of the law. Okay, because of that, it is very easy to start a sole proprietorship because you as a human already exist. Okay, so all you really need to do is do a little bit of local registration, and sometimes there's some licensing, so maybe some insurance that you want to look at getting. Okay, but those are quite simple when starting the business, so it's fairly easy and quick to get started. And as I mentioned, there's zero legal separation between that business and that owner. So, what are some advantages of this? Why would you choose this structure? Well, as I mentioned, it is very quick, it is very easy, and it is very inexpensive to establish. 80% of new businesses are started each year as sole proprietorships in Canada. Okay, as I mentioned, generally there's only some registration, licensing, possibly some insurance. Okay, all profits are owned by the owner. So if you start a sole proprietorship, you are the main owner. So any profits that the business makes, that's your money. And in essence, it is your personal money. There's no loopholes that you have to go through to get your money out of the business. Okay, you can literally walk in and take it out of the cash register, and that is your money. That is your personal income. Okay. As the sole owner, you get to make all the decisions. So if you have a very clear idea of what you want your business to look like, this is going to definitely be an advantage. What might be some disadvantages though? Okay. The disadvantage of a sole proprietorship, of your business and yourself being considered the exact same thing under the eyes of the law, is what we call unlimited liability. What that means is that if your business owes money. So if you were to take out a loan, for example, and the business owes the bank $50,000 and the business isn't making money and you decide to shut down the business, you as a human being still owe $50,000. And if you don't have that money, the bank is going to come and take anything that you as a human own, which could include your personal car or your house or your retirement saving, or even some investments, some stocks, your jewelry, even savings for your children's education. Okay, so by starting a sole proprietorship, it's quick and easy, but because there is no separation, you are opening yourself up to these things, and possibly, if you're in the situation, your spouses. Okay, so if a couple is married and let's say the wife starts a new business that involves taking out some debt, okay, the husband needs to be aware that that bank could come for their house and their car as a result of that. Okay. It can be harder to get money at the start for starting a sole proprietorship. As I mentioned, it's just you as an owner. So really the ways that you're going to get money at the beginning is money that you've already saved or going to the bank to get a loan. When you go to the bank to get a loan, like I said, it's you as an individual walking in. So if you already have a mortgage, if you already have a car loan, or if you are young and don't have a very high credit score or have no history with borrowing money, it's unlikely that the bank is going to be willing to give you very much money. We said as one of the advantages that being the only owner, you get to make all the decisions, but there could also be a disadvantage to that in that maybe you don't have the knowledge or the skills that are necessary to make all the decisions. Okay. There's also a lack of continuity. So what we mean by that is over time. The business is a person. So when that person no longer exists, the business no longer exists. So what that means is if the owner dies, the business is done. There is no way in a sole proprietorship to change ownership. You hear of people, passing on their business to their children or selling their business or, it continuing after they die. That cannot happen with a sole proprietorship, which is often one of the reasons that we see people maybe start as a sole proprietorship and then change their ownership structure later on. Okay. As we mentioned, the money that comes into the business is the profits that the business makes are your personal money, which is great. It's very easy to get at your money. However, something to be aware of is that that money is therefore considered personal income and is therefore taxed at a personal income rate. So in Canada and Ontario specifically, our personal income tax depend on how much money you make. Okay, so they could be as high as over 40% of your income that you earn gets taken by the federal and the provincial government as tax. Businesses only pay roughly 20% tax. So you can see if your business is quite successful, having this money come in as a personal income is going to end up having more tax taken from it. Also, because it is a sole proprietorship, because the business is you, there are some limited options for employee compensation for the way that you are going to pay your employees. So the next structure that we're going to look at is a partnership. So in this case, we do have more than one owner, as you can see. Okay, but they are still in or attached to that box, meaning that the law still does not distinguish between the business and the owners. Okay, so basically a partnership is a sole proprietorship with more owners. Okay, it doesn't need to just be two, it can be, 3, 4, 5, 6 even. Okay, but it's just that there is more than one that is there. Okay, things to note, because there is more than one owner, profits are going to be divided between all of those owners. Okay, it doesn't need to be equally, but there is a set out way that that is going to happen. Okay, but because the business and the individuals are the same in the eyes of the law, that profit, whatever share of that profit that each partner receives, does still get included as personal income and therefore is taxable at that personal rate for a partnership. Oh, let's look at some of the advantages of a partnership. Just like the sole proprietorship, it is quick, easy, and inexpensive to establish. Okay, but probably better than a sole proprietorship would be that you get to combine the talents and the resources of more than one person. So we mentioned before that as a sole proprietor, you have to make all of the decisions, okay, but maybe you're not great at everything, or you don't have training at everything. When you have partners, you can kind of divide and conquer. So I may be great at accounting, and somebody else may be great at managing people, and somebody else may be really good at marketing, and we're able to kind of put all of those things together. For resources, those could be physical resources when we're starting out, okay, things like vehicles or even equipment, but it could also be money that each partner is bringing into the business as well. Okay, there's very limited regulations on partnerships, basically the same as a sole proprietorship. There is no requirement that you even make an agreement between partners that sets out how money will be divided. But however, it is highly recommended that you do create a partnership agreement before starting a partnership, which is a legal document that you get lawyers to help you create that, sets out a lot of information, especially about how profits will be shared, what will happen if somebody wants to leave the business or if the business goes under. Okay. There is more capital resources, i.e. generally money, to start the business. So to start off with, being personal savings. We mentioned as a sole proprietorship, generally you're only going to have whatever you've saved. If I've been able to save $5,000, okay, maybe not enough to start the business, but if I have 3 partners, then all of a sudden that's $20,000 to start a business, which is significantly more. Also, if you're going to the bank to get that money, a bank is much more likely to give you a loan if there's multiple people signing on it, because they're creating that additional backup to get their money back. So we mentioned that, if you're a young entrepreneur, you may not have a credit score, or you may not own what they call collateral, big assets that they can come after, like a house or a car. But, if you have a number of partners, maybe some of them will have those things, or the combination together makes it seem more secure to the bank, and they're more likely to give you that loan. Okay, some disadvantages to consider, however. Okay, it's important to know that partners still have that unlimited liability that you have in a sole proprietorship. Because the business and the owners are the same in the eyes of the law, any debts that the business has are on the partners. And it's important to note here that even if you have a legal partnership agreement that says, profits are shared 50-50, that doesn't mean the bank is going to come after each owner 50-50. The bank wants their money back. So if one owner has nothing, they're going to take the full debt from the other owner. So it's really, really important that people understand this when they go into a partnership, and they understand that they really are legally linking themselves to somebody else and putting their own assets and credit scores at risk there. Well, working with somebody sounds really, really appealing to a lot of people. Multiple hands, multiple brains. Okay, there are other ones who this doesn't sound good to, and all of us have worked in teams before. Our partners, even on schoolworks. Okay, sometimes you don't get along, or sometimes you just disagree. Okay, and this could be 5 or 10 years down the road on where you want your business to go afterwards. Okay, and that can be detrimental to partnerships. Okay, as I mentioned before, we are still getting taxed at that higher personal tax rate. So any profits that are made split between the owners, and it's going at that higher individual rate. And with, working with somebody else, we mentioned disagreements, but it can also just be difficult to make decisions as you go. As a sole proprietor, starting a business, there's a million decisions that need to be made. They come at you, you just decide and you go ahead. But if you're always, needing to check in or talk about it, it can definitely slow the process down or just make it more difficult to get done. Okay. And as I mentioned, partners are liable for each other. Okay. Abraham Lincoln, a very famous U.S. president, he actually started a business before his presidential campaign with a very good friend of his, and the business went under, and it went under very quickly because his partner was stealing money out of the cash registers on a regular basis and wasn't pulling his weight in the business. Okay, so that's a very bad case scenario, and we don't like to think that people that we're friends with or people that we go into business with are going to do that, but it is just something that we need to be cognizant of and understand that you really are tying yourself to that other person. All right, and finally, we are going to talk about a corporation. Okay, a corporation is set up quite different than a sole proprietorship or partnership, distinctly being that you as the owner are outside of that box. Okay, you as an individual are a completely separate legal entity than the business itself. Okay, so this is a really important distinction, and this is the main distinction. So when we talk about a business incorporating, becoming a corporation, this is exactly what they are doing. They are going through the process of basically, in the eyes of the law, birthing a new legal entity, creating a new legal entity, which is the business itself. Okay, the law views the business as its own entity. So in this case, the business would take out a loan in the business's name. The business would hire employees, and it would be the business that has a contract with them, not the individual owner or owners. Okay. The business itself, again, is its own legal entity. So it's the business that can be sued and can sue others. Okay, it's the business that can have debts, not the owner. So as you can imagine, this is actually providing a lot of protection to the owners themselves. In a sole proprietorship or a partnership, we talked about debts, but if somebody was suing your business for doing something wrong, they're suing you as an individual. And again, they can come after your personal items. Whereas with a corporation, they cannot. They can only go after what the business itself owes. Okay. If you have multiple owners in a corporation, that's fine. But when we talk about owners, we talk about it in terms of shares. So because the business itself is its own legal entity, okay, we don't talk so much about having owners, but we talk about the ownership of it being represented by shares. This could be one share. That's the full ownership. This could be two shares that are shared between two people. Or this could be millions of shares that are sold every day on the stock market, like big companies like Apple have it. Okay, so that's where kind of stocks and shares come from. They are pieces of the ownership of a corporation. Okay, a few more distinctions with a corporation. Any profits that the business incurs, if they want to give these to their owners, which we call shareholders, okay, these owners can't, like a sole proprietorship or partnership, just pull that money out of the bank. They can't just go and take it out of the cash register. Okay, there is a different legal way for this to be done, and it is called dividends. Okay, so if at the end of the year the money is made, the business has made a profit and the business has said, yes, let's give that out to our owners, they are going to what's called issue dividends, which is their formal vehicle of getting that money out to the owners. Okay, this in Canada and in Ontario has its own taxation method, okay, which is lower than personal income for the shareholders. Okay. How dividends are decided, basically, it's about how many shares there are. So, if there's $1,000 and there's 100 shares, each share gets $10. If you own 5 shares, you get $50. If your neighbor owns 2 shares, they get $20. It's very simple and straightforward mathematical calculation. As I mentioned, there can be a single share or there can be millions of shares. There are many, many businesses that are corporations that are not sold publicly, that are not on the stock exchange, okay? There are many people who started their businesses as a sole proprietorship, but, maybe they want to sell their business or they want to pass their business on to their children. What they can do is they can incorporate the business. The business is now its own legal entity that will live forever, and there is a single share, and then all they have is that piece of paper or virtual share, and that they are physically going to pass to somebody else to pass on that ownership. So it just really simplifies that process. Okay. As I mentioned, they can be publicly traded on the stock exchange or they can be privately owned businesses. So let's look at some advantages of a corporation. Okay. As I mentioned, corporations live forever. It does not matter what happens to their owners. They are going to live forever. They are their own legal entity. Okay. All of their shareholders or owners have limited liability. Okay. And so what we're talking about here is, as I mentioned, all of the debts are in the business's name. Okay. The only thing that an owner can lose would be the amount of money that they paid to buy that share or to have that piece of ownership. Okay. If the business defaults on a loan, the bank cannot come after them personally. If the business is sued, they cannot come after them personally. It very, very much protects those owners and keeps them separate from the business. As I mentioned, very, very easy to transfer ownership. So easy, in fact, that's why we have a stock exchange. People buy and sell pieces of ownership of Apple or other businesses that are publicly traded every single minute of every single day. As I mentioned, the taxation is going to be different, and in certain situations, it ends up being lower. So the business tax rate is much lower, and in the higher brackets, it's less than half of what a personal tax rate would be. Okay, the business would pay that on any profits, and then after they've paid that, they could then distribute those profits to their owners as dividends. And as I mentioned, those have a much lower tax as well. So the total amount of tax can be much lower on that money that's made. Okay, so I don't know about you, but this sounds like an amazing list to me, right? All of those disadvantages that we heard from the sole proprietorships and partnerships are taken care of for corporations. So maybe we wonder why not everybody does that. Okay. The main difference is that it's very expensive and it takes a long time to incorporate a business. Okay. You are creating a new legal entity. You are basically birthing a new item in the eyes of the law. Okay, there's lots of registration, which comes with fees with the government. Okay, there's a number of things that you have to prove, including name searches and copyrights and all of those kind of things. And all of that work needs to be done by lawyers, and you need to pay your lawyers to do all of those things. Okay, this is why, even though it sounds amazing, as I mentioned, 80% of brand new businesses come in as sole proprietorships, not as corporations. Okay, if we're going to spend this amount of money, we want to know that the business is going to work. Okay, as well as that initial setup fee and time, there is also a requirement, a legal requirement that accountants, and which includes some lawyers, do an annual reporting. Okay, what this is an outside accounting firm is going to do what's called an audit, where they're going to come in and they're going to check and they're going to make sure that what you are saying financially is happening in the business is actually happening in the business. Why? Because it's a legal responsibility that every year you post your financial status with an income statement and a balance sheet. Okay, and it needs to be verified that it's done. This is very expensive. Okay, it depends on the business. Okay, but even the smallest of businesses, it could require an accounting team being at your office for a week or two. Okay, and you are paying those high fees for them to be there, and that's assuming that everything looks good. So that's another yearly fee that you have to be worried about. Okay. If your business is unsuccessful and doesn't make a profit and has a loss, as a sole proprietorship and a partnership, you can actually offset that against your personal income. So what that means is if I'm still working a job and I'm making, let's say, $40,000 a year, if I start my business and in the first year it loses $20,000, okay, I can basically say, well, I made $40,000, but I lost $20,000, so I'm only going to pay taxes on $20,000. Okay, what the difference is. However, if your business is a corporation, it is different than your individual, and so nothing that the business does can affect your own personal tax situation. So as a new entrepreneur starting out, this is something to consider, because generally it takes at least 2 years for businesses to be profitable. So if your business is going to be losing money, there may as well be some advantage to you of that. Okay. Even though there is an unlimited liability, we have to be very, very careful when we are going through the process of incorporating. Okay. Because if personal assets, houses and cars of the owners, were used initially to secure loans, okay, then they could still be seized. Okay. An example I can give for you is if you were to start a brand new business as a corporation, you decided, you wanted all of this. You may go to a bank and they are basically looking at this corporation like a baby. It has no credit history. It owns nothing. Okay. There is nothing here to tell me that I'm going to get paid back, and they're not going to give you a loan. So then you may, as an individual, still have to sign off and say, I will put myself up there, my own personal savings and house and car, if this loan doesn't get paid back. So even though the structure itself has that limited liability where they're not going to come after you, you may still have to put yourself on the line when you're starting out. Okay. And we also sometimes talk about double taxation. So while the tax rates are lower, depending on what you are trying to do and how you're trying to get your money out of the business, you may be seeing money taxed twice. Okay, where we see this is when an owner works for a business and is taking a salary. So if you start a business as a sole proprietorship and you're able to take 20,000 out of it every year as your salary, okay, you're just taking that out and it's being taxed at a personal rate. If your business is a corporation, okay, any money that the business makes has to pay tax. And then when you take it out of the business, you also have to pay personal tax on it. Okay, so it's what we're calling this double taxation. It can be beneficial for the lower rates if it's as a dividend, but in other situations, it could be more detrimental to you depending how you're setting that up. So with all of this information, how are we going to go about choosing an ownership style? As I've mentioned before, especially when creating a venture plan, but before we start a business, we need to choose what ownership style we're going forward with. Okay, and again, we're thinking of this as a scenario of starting a brand new business. So what generally happens and what is generally suggested is that brand new businesses from brand new ideas start as either a sole proprietorship or a partnership. Why? Because it is simple. Okay. Basically, all you have to do is decide, are you doing this on your own, or do you want one or two or three other people on your team of ownership? Okay, this could come down to a decision about, kind of having that money to start or the skills or the ideas, etc. But that's what you're doing. The reason it's only a sole proprietorship or a partnership, as I mentioned, this is the simplest way to do it. We don't know if this business is going to work. If you're doing an invention or an innovation, we don't know if this is going to be successful. So it's probably not worth it to spend that huge sum of money to incorporate originally, especially when, as I mentioned, you may have to go out and take the loan in your own name anyway. However, that being said, knowing what we know, okay, we want to, when the time is right, to incorporate our business or change from that sole proprietorship or partnership to a corporation. Okay. Again, that move gives us that personal protection. It gives us those lower taxations. If you make your shares publicly available, it can give you more funding, etc. All those advantages. But again, waiting until that business is established, it is starting to grow, it is making money, and it's necessary. Okay. If your business isn't making money, who cares if that, what tax rate that money would be at, because you're not making it. Okay. So generally, this is what we're going to see. It's very rare that businesses start as a corporation. We are generally seeing them and suggesting that they start as that sole proprietorship or partnership. I've kind of skirted around these, but I just want to talk really quickly about methods of financing. So when choosing your ownership style, you do need to be aware of how you are going to try to get the money to start your business. If you are planning to work with an investor, especially if the investor is somebody that you don't know, if you're going to case competitions, etc., there is a good chance that those investors will require your business to be a corporation. Why? Because if you remember, an investor it would have to be in partnership for you to have an investor, either a partnership or a corporation. Okay, as a partnership, they are legally linking themselves to you. Again, somebody that they do not know, and they personally become liable. Okay, that's generally not something investors want to do. If you are a corporation, then they are basically just taking shares of your business in exchange for money. And it's all much more legal, much more documented, much more professional. However, if you are planning to go to the bank, which I've already kind of touched on, they prefer sole proprietorships and partnerships. Okay, for that purpose of unlimited liability. Okay, if a bank is going to give a loan, they need to know that there's something that they can take if you don't pay back that loan. Okay, knowing that it's linked to you as a person and they can come after your own personal assets and savings and bank accounts is going to make them more likely to give you that money. As I just mentioned, a new corporation is like a baby. It doesn't own anything and it doesn't have a credit score. It doesn't have a history of if it will pay back the loan. Okay, so it's very unlikely that they are going to give you that loan. And as I mentioned, they then may require that personal guarantee anyway, which you might as well then just be that sole proprietorship or partnership for. All right, entrepreneurs, that is your lesson on business ownership. It is now time to make your decision. What are you going to do? Are you going to start as a sole proprietorship, partnership, or a corporation?
Thank you so much for watching today's lesson, brought to you by Plugin to Learning. All the resources used in this video are linked in the description below. If you have any questions, feel free to comment. And to continue learning with us, please subscribe.